Imagine waking up one morning and discovering that every price you see, from the cereal in your cabinet to the rent you're struggling to pay, was never determined by the economy, the government, or even the market. What if it was dictated by a hidden financial engine built over a century ago, by private hands? In boardrooms you and I will never be allowed to enter. In this alternate timeline, nations didn't rise because of democracy, industry, or innovation. No, they rose because a select group of private banks engineered the rules from behind velvet curtains. And the punchline: they still run the system today. Your inflation, your debt, your job insecurity, all symptoms of a money machine designed to feed itself first, and everyone else last. And what if I told you that buried deep beneath the headlines and official histories is a mechanism so complex, so deliberately hidden, that it makes every financial crisis look less like an accident and more like a controlled burn? We're going to pull that curtain back. But before we dive into the forbidden archives, drop a comment. Where are you watching from? And if you're new here, hit subscribe and join the community that looks for the unfiltered truth hidden in the cracks of the official story. Because today, we're following the money. And the money leads somewhere darker than you think. The official textbooks in this universe tell a comforting story. Nations built central banks to stabilize their economies. They claimed these institutions were the heroes, smoothing recessions, taming inflation, and keeping currencies safe. But if you dig into the forgotten footnotes, the pattern becomes impossible to ignore. The past starts to echo the present. You'll see how a handful of early private financiers didn't just influence governments. They became the government's gravitational center. In the early 1800s, during the reconstruction of shattered European economies, private banks stepped in to help. They offered liquidity when no one else could. They bought government bonds when no one else dared. They saved currencies that were collapsing under their own weight. And yet, the modern parallel is impossible to miss. Every time a crisis emerged, the same cycle repeated. Nations borrow, private banks lend, and with every loan, sovereignty shifts by a fraction of a percent. Fast forward to the early 1900s, the era when central banks in our fictional world were officially formed. Newspapers called it progress. Politicians called it stability. But the modern parallel is chilling. Legislation was written by committees, composed of the very financiers who would later become the primary beneficiaries. The past mirrors the present again. When you examine wartime economies, nations needed funding. Private institutions stepped in at a price. Entire countries mortgaged their futures to survive the moment. Sound familiar? Because the modern parallel is brutally clear today. Debt-ridden governments beholden not to their citizens, but to balance sheets. History, as written in this alternate world, wasn't a story of nations building financial systems. It was the story of financial systems building nations, and waiting quietly for the moment they'd take control. Here's where the alternate history takes its sharpest turn. Behind all the treaties, the restructuring plans, the public institutions, there was one mechanism that quietly rewired the global financial order. A mechanism engineered for complexity, plausible deniability, and permanent dependency. The shadow liquidity web. Not a single institution, not a single market, a network, a hidden circulatory system, controlled by private banks that could create money-like instruments without calling them money. A mechanism that allowed them to move capital across borders, bypass oversight, and when needed, pull liquidity from nations like siphoning oxygen from a sealed room. And the architect of this web, the documents name someone. A person whose title you know, but whose power you've never considered. And in a moment, we'll reveal who it is. But you won't believe the name. The receipt is wilder than you think. To understand the shadow liquidity web, imagine a spider's web stretched across continents. Each thread looks fragile, barely noticeable, but when woven together, they can suspend the weight of entire nations. At the core were liquidity nodes. Private banks granted the ability to issue synthetic credit obligations, or SCO. These instruments weren't officially currency, but they functioned like it. They could buy bonds, they could fund governments, they could support collapsing markets, and they did it all off the official books. Because SCOs existed in what the fictional documents call parasitic finance channels. They avoided public accountability. They were invisible to domestic regulators and immune to parliamentary oversight. By 1928, the web processed more than $400 billion in shadow obligations, an astronomical figure in this alternate timeline economy. By the 1950s, it represented nearly 38% of all sovereign debt transactions. By the 1970s, it had grown so large that a single liquidity withdrawal caused a 21% overnight collapse in a major nation's bond market. This wasn't a safety net, it was leverage, and private banks wielded that leverage like a blade. Example, in 1964, a mid-sized nation attempted to nationalize its mineral resources. Within days, 3 major liquidity nodes reassessed exposure, yanking $19 billion in SEO-backed liquidity. The nation's currency dropped 41% in a week. The government reversed its policy within a month. Engineered collapse, manufactured consent, financial coercion dressed in the polite language of risk management, and the brilliance or moral hazard of the system was that it created dependency loops. Once a government plugged into the web, unplugging risked immediate economic suffocation. No politician would dare. No voter would understand. The shadow liquidity web also enabled synthetic nationalization, private ownership of public debt. By the late 1990s, over 62% of all government refinancing in this fictional timeline flowed through web-based structures, effectively allowing a network of private banks to decide which nations survived and which sank, all without a single vote cast. Greed wasn't a byproduct. It was the design philosophy. Illusion wasn't accidental. It was the delivery system. Collapse wasn't unfortunate. It was engineered when convenient. And once you grasp the architecture, the big reveal becomes unavoidable. In this alternate timeline, the shadow liquidity web didn't vanish. It evolved. It digitized. It accelerated. It integrated with algorithmic trading, quantum-optimized risk engines, and cross-border synthetic credit platforms. The system is faster, bigger, less accountable than ever. And if history teaches us anything, it's that systems built on borrowed time always collapse. The only question is whether nations fall softly, or all at once. The deeper truth: people don't fear the conspiracy. They fear the possibility that they've been living inside it, benefiting from it, without ever seeing the strings. But seeing the strings is the first step. So let me ask you, are we wiser now, or just walking the same path in better suits? If you're ready to keep pulling this thread with us, hit subscribe, share this video, and comment below with your skepticism. Because in this world, fictional or not, questioning the system might be the only real power the people have left.